Hi, I'm Pattu from freefincal. Today let's talk about why investing in actively managed small cap mutual funds does not make any sense. A few days back, I had talked about how we discussed how many mid cap funds outperformed Nifty mid cap 150 quality 30. It turned out that not many mid cap funds are able to beat even the Nifty mid cap 150. Forget about the quality 50 index. Sorry, that should be quality 50 index. I keep making that mistake. So I said that it makes no sense to invest in actively managed mid cap index funds a few days back, and I think we're gonna come back and the same conclusion here for the small cap mutual funds also. So what we're going to do is to use 4 benchmarks, and we're going to use our usual style of analysis. We're going to look at every possible 3-year, 4-year, 5-year returns, and we're going to compare the returns of the actively managed small cap funds with 4 benchmarks: Nifty small cap 250, Nifty mid cap 150, Nifty next 50, and Nifty mid cap 150 quality 50 TRI. This time I wrote it properly as quality 50. So many people will ask, how does it make sense in comparing a small cap fund with a mid cap index? Now, if I was an analyst or trying to publish a paper in academia or something like that, then I'll probably stop the comparison with Nifty small cap 250. But then I'm not those. Here in this context, I am an investor trying to get more bang for the buck, and if there are better options than actively managed small cap funds which can give you better returns at lower expenses and possibly even lower risk, then why would I choose a small cap fund? It makes no sense. So that's the kind of thinking with which this analysis is made, and let's look at the numbers. So there are total 25 actively managed small cap funds, but only 14 of them are old, in the sense that if you look at the 3-year, 4-year, 5-year returns, only 14 of them have got at least 500 data points of 3-year, 4-year, 5-year rolling returns. Rolling return means looking at every possible 3-year, 4-year, 5-year returns by moving the return window by 1 day, by each business day. So we shall now define a rolling return outperformance consistency. So let's say there are a total of 876 3-year fund returns, and we compare them with 876 benchmark returns over the same duration. Then if the fund has beaten the benchmark 675 times, then the rolling return outperformance consistency score will be 675 divided by 876, which is about 77%. So we shall expect from actively managed funds an outperformance of 70% or more, because they are charging a heavy fee. We need that kind of a outperformance score to justify the fees. Now we do this kind of analysis in the monthly mutual fund scanners, and we screeners, not scanners. And so we are basically these studies based on that. So now we'll start with small cap funds versus Nifty small cap 250. Now 10 out of 14 funds have a 70% or more rolling return outperformance consistency. We'll call that as qualified. So 10 out of 14 funds qualify over 3 years, 9 out of 14 funds qualify over 4 years, 11 out of 14 funds qualify over 5 years. That's not bad at all. And if you take 3 plus 4 plus 5 years, 9 out of 14 funds still qualify. So that's certainly quite a good performance with respect to the mid cap index. But then, is the mid cap index too easy to against the small cap index? Excuse me, that's a good performance against the small cap index. But then, is the small cap index too easy to beat? That's the question we are going to pose. So if we now compare it with the Nifty mid cap 150, only 2 out of 14 funds qualify over 3 years, only 4 out of 14 funds qualify over 4 years, only 4 out of 14 funds qualify over 5 years, and over 3 plus 4 plus 5 years, only 2 out of 14 funds qualify. That's a dramatic drop in performance. That tells you that for an actively managed small cap fund to beat the mid cap 150 is pretty tough. Now let's go to our beloved Nifty Next 50. Again, only 3 out of 14 funds qualify over 3 years, 5 out of 14 funds qualify over 4 years, 7 out of 14 funds qualify over 5 years, over 3 plus 4 plus 5 years, 3 out of 14 funds qualify. That's not bad, a little bit better compared to the, I should say it's a little bit better compared to the Nifty Midcap 150, but still on an absolute level, it's quite bad because not even half of them are able to beat the Nifty Next 50 on a consistent basis over 3 and 4 years. Only half have done it over 5 years. So that's a poor performance with respect to Nifty Next 50, but slightly better than Nifty Midcap 150. Now, with respect to the Quality 50 Index, only 1 out of 14 funds qualifies over 3 years, over 4 years, 2 out of 14, over 5 years, 3 out of 14, and only 1 out of 14 over 3 plus 4 plus 5 years. That's expected because, I mean, we know that the Quality 50 Index has been harder to beat than the Midcap 150 Index. So now what do we do? Our recommendation is do not invest in actively managed small cap funds or mid cap funds. You have two choices. One is, if you don't like the way the Quality 50 Index is defined, if you don't like factor based investing, if you say that it's based on arbitrary definitions, it's based on data mining and so on, then you can very well choose Nifty Next 50. Nifty Next 50 has performed very well with respect to small cap indices. We have already shown that it does well against mid cap. Nifty Next 50 has performed well with respect to small cap funds. It has already we have already shown that it performs well with respect to mid cap funds as well in the past videos. So if you don't like factor investing, if you don't like the quality factor definition, you can choose Nifty Next 50. Of course, you have to be it'll be a little bit frustrating, but you have to bear that frustration. That's life. If you don't mind the Quality 50 definition, then you can go with UTI Nifty Midcap 150 Quality 50 Index Fund. So those are the two choices I see for both active midcap investors as well as active small cap investors. Stay away from all ETFs. Do not use the midcap 150 index fund. Do not use the small cap 250 index fund because the tracking errors will be quite large, because in this sector the impact costs will be large because the liquidity is not much. So you will have tracking errors. You will lose 1.5-2% just by tracking error. You will lose. So it's not worth it in my opinion. You take a chance with either Nifty Midcap 150 Quality 50 Index Fund from UTI that also can have tracking error issues, or you choose a well-established Nifty Next 50 fund. So those are the two options I see, and it makes no sense for investors to invest in small cap funds. Now, suppose people say that, look, I have a fear of missing out. I don't want to miss out on my small caps. Then I have already posted a video saying do not use SIPs for small cap funds. There are tactical strategies which you can use for small cap funds. Have a tactical exit and entry plan. Try that. That may be more rewarding. I don't know. It's not a guarantee. That could be more rewarding or may not be. I don't know about that. But that's if you say that I don't want to give up my small cap funds, then at least don't buy and hold blindly for the long term, because things can swing up and down quite a bit. So it may be better to tactically enter and exit these funds.